So you want to build a retirement portfolio you can trust in your golden years. Well, you've got a choice to make: total return investing or income growth investing. The fate of your retirement could hang on your decision, and it's a tough call. So let's settle this with a good old-fashioned investing debate. Two strategies enter, but only one will be crowned the winner. Which will it be? You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and we've got a timeless investing debate lined up for you today that's equal parts fast-paced, informative, and of course fun. We're pitting two veteran DIY investors against one another in defense of the strategies they're banking their own retirements on, both with great success so far. And best of all, it's you, the viewers, who will decide the vote outcome here. So let's get down to business here. In one corner, arguing for total return investing, is Mark Seed, founder of My Own Advisor. He's a DIY investor with over 20 years experience who runs the popular investing blog, My Own Advisor. And he just kicked off his own early retirement this year, so way to go, Mark. And in the other corner, arguing for income growth investing, is Henry Ma, founder of Your Ever-Growing Income. He's a DIY investor with over 30 years experience who's retired on his portfolio of dividend stocks. He writes regularly on his blog, and he's author of, get this, 4 books on income growth investing. So, gentlemen, great to have you both on the program here. Looking forward to a spirited debate.
Hi, Robert.
Hi, happy to be here.
Yeah, we've had both of you guys comment on each other's strategies in episodes all your own, so now we're bringing you all together here. I love it. It's a great dynamic here. But listen, before we dive into our debate, I just want to give people a quick rundown of your investing strategies for those who may not be familiar. So Henry, let's start with you. What is income growth investing and why do you like it so much?
Well, quite simply, the title says it all. You invest to earn an income from every dollar you put into the stock market. And for me, I consider it really a totally different strategy. I don't compare it to total investing at all. And, the reason is that our objectives are different. I invest solely to earn an income, and I'm not concerned about capital appreciation. I expect to receive capital appreciation, but I don't concentrate on it. And, if I look back a number of years, I think I have to, when we were investing for capital appreciation, we found that we couldn't rely on capital gains to fund our retirement. The stock market was too erratic. Maybe we weren't a good enough investor, but we found that we just couldn't rely on it. And I found an article way back, probably in the early 2000s, written by Tom Connolly. And in that article, he had 2 simple statements. One was, if a company doesn't pay a dividend, don't buy it. And if it doesn't grow the dividend, don't buy it either. So that really struck an chord with me. And over time, we found that one really can invest by just following those 2 simple rules. Certainly there are other aspects to investing that you have to follow, but those 2 guiding principles served us well through the financial crisis, and it's continued to serve us well through our about 17 years of retirement. So that's the point I really wanted to start out making, is that I consider income growth investing a totally different strategy than investing for total return.
Yeah, certainly. And so taking Tom Connolly's words there and running with them, and I know you've made it all your own too. You've got a very specific set of criteria that you use as well here too. So fascinating to hear that approach here. Mark, your turn now though. What is total return investing and why do you like it so much?
Yeah, thanks, Rob. And I appreciate the segue, Henry, to what I'll talk about, because I think ultimately, and we'll talk about it a little bit more, if the companies you own don't have higher earnings and higher growth, then you may or may not get those dividends, right? And so where I'm coming from is total return investing is really generating your balanced mix, if you will, of dividends, capital appreciation, and interest, right? So it's really looking at the total picture, basically, as the name suggests. And I'll be honest, early in my investing career, I wasn't actually focused on total returns. I thought that the income from my portfolio may or may not be the be-all, end-all. And, there are pockets and there are investors out there who really want to focus on just the income generated from their portfolio, and that's totally okay, and we'll talk about that today. But I think if we're missing the growth component, you're really missing a huge opportunity to potentially gain more money, spend more money, and enjoy a little bit more money as you age. And so ultimately, the appreciation of the stocks that you own and or the dividends that they may or may not pay really is the value proposition for all DIY investors. And there are ways to do that these days through low-cost exchange-traded funds, low-cost other products, that you can build a very responsible, diversified portfolio that captures kind of what I call in my hybrid strategy, the best of both worlds. You can own individual stocks that you're choosing that pay dividends and they may offer capital appreciation that you alluded to, and you can also own low-cost global ETFs that capture the world of returns. And so I really like the premise of focusing on where you can the best possible returns.
Right, yeah, you're pretty agnostic as to where you get those returns. You just want to get them one way or the other. So that's the total return approach here. Great stuff, guys. Thanks for laying out your approaches to investing here. Now let's get down to our debate here, okay? Which of total return or income growth investing is the better investing strategy? And I just want to lay out the rules here for you and our audience here. So you're each going to have a chance to present your opening arguments for your position, and then you're going to have 2 opportunities to counter your opponent's arguments and fill in any gaps in your own argument. I'll also jump in with some of my own questions towards the end there, and then we're going to have our audience vote on which of the 2 of you they feel made the stronger case. And whichever one of you can swing more viewers to their side is going to be crowned our winner here today. And viewers, if you want to get in on the conversation, of course, and make your voice heard through your vote, we'd love to have you here. So if you're watching from our broadcast platform, you can choose an option from the poll on screen that you'll see. If you're joining us on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can cast your vote. And if you're watching on Webbroker, you can use the questions box. Just send us Mark or Henry as your response there, and that'll count as your vote. So you can vote at any time during the program here, but I suggest, obviously, that you hear both sides before you do. You might have some of your preconceived notions challenged here, so stick out for that. Plus, of course, you can submit any questions that you may have for our guests on all things investing, dividends, total returns, what have you. We're going to get to as many as we can at the end of the show. With that said, let's get things going here. And Mark, I want to start with you here and your opening arguments. So lay the case out for us here. Why is total return investing the better strategy in your mind?
Yeah, so I think I have 3 points. They're all related, Rob and Henry, but ultimately I think it's a proven winner. So we've seen stock markets go up and down. We've seen the volatility early this year. But ultimately, when you look back year over year in terms of market history, this is a total winning approach, right? You're getting the mix of dividends, capital gains, some interest. It's basically been a proven winner. Given that dividends actually represent a portion of the company earnings that are distributed to shareholders, maybe like Henry and myself and many other DIY investors, you're ultimately relying on companies to perform well. You're relying on your individual stocks to deliver higher earnings, deliver higher growth over time. And so ultimately, if those companies aren't performing and growth isn't occurring, you may or may not get paid. The second point I'd want to raise is I've actually lived through this in terms of personal experience. And, Henry's been successful with his approach, no question, and kudos on that approach. But ultimately where I'm coming from is from a total return perspective, I've seen where a bias to potentially some TSX only stocks has actually limited my total portfolio value. So when I think about, investing in maybe just the TSX or certain TSX stocks, I'm actually limiting my investing universe a little bit, right? I'm purposely I'm limiting my investing universe. And so when I look at the returns in my early investing years, not necessarily including the US stock market or international markets, I actually may have lost a potential to gain more portfolio value. And to me, more portfolio value is actually more spending now that I'm actually in my semi-retirement years. And the third point I want to raise is that while TSX stocks, so stocks that are listed on the Canadian TSX, may be fairly dividend friendly, They may have a great history of paying dividends. Some of them may have an excellent history of growing dividends as well. The reality is that some dividend-paying companies, as friendly as the histories have been, dividend cuts can and do happen. And I think we've seen recently a recent orphan and widow darling. We probably all know the name that has recently cut their dividend. And so that may or may not have a big impact to investors like Henry or myself. But from the premise of diversification, owning many companies in many sectors, a global pool of stocks from around the world, you're basically not taking as many concentrated stock bets. And by that principle alone, diversification can be your friend. So in terms of a wrap on those things, it's a proven winner. History has demonstrated that. There's nothing to suggest that a global basket of stocks in many sectors and many countries won't perform well in the future, albeit returns are always questionable in any given year. I've had personal experiences where I may have missed out potentially on huge U.S. growth or other sectors in the U.S. market or international markets. And thirdly, I recognize that as concentrated as some companies may be in terms of growing their earnings, their share prices, or what have you, you're making concentrated bets and you're actually purposely limiting your pool of investment returns. So points 1, 2, and 3, Henry, over to you maybe, but Rob.
Yeah, very strong opening argument there, Mark, laying out the points for us here. Henry, but it's your turn now for opening arguments. So give us your case on income growth investing and why you feel it's the better strategy.
Well, you can start off with one single word between the two strategies, and it's uncertainty. That's kind of the kicker. No matter the potential growth, no matter how good you think you are as an investor, there's always that level of uncertainty. And, when I look back, I started investing before the dot-com bubble. And the dot-com bubble was 1999 to 2000. And we were investing, as Mark said, for capital gains, total return. We weren't concerned about dividends. But after the dot-com bubble, we realized that, hey, we can't rely on the stock market. I mean, it dropped 30 to 40 or 50%. I think the NASDAQ dropped 70%. And we realized that we had to find a better way to fund our retirement without relying on the stock market to provide those kinds of growth. And that's when we, looked for an alternative. And we found income growth as, or at least dividend growth investing. But within a short period, 6 years, we had the financial crisis. So within a period of 10 years, I went through two major financial crises, and both of them, stock prices dropped, and it took 5 to 6 years for the price of those stocks to recover. But what was different between the first one and the second one was that our income didn't drop. In fact, it continued to grow throughout the financial crisis, and it's obvious that when the stock market goes down, the price of stocks go down. And when you invest for income, you look forward to down markets. In fact, you welcome a market crash. But, we haven't had one since 2008, 2009. That's 17 years. So I think people have begun to become accustomed to the fact that, the market is, will recover. We've had volatility. We've had the COVID crisis, which only lasted for a month or two. But people sort of expect that the market's just going to recover quickly. They'll hit new highs and it'll continue on going up. But the market is unpredictable and certainly uncertain. So we could end up in a situation where we could have two financial crises within a 5, 10, 15-year period. And that could seriously affect your capital position, especially if you were retiring just when those market crises came up. With income growth investing, your income grows continuously. And I noticed you put up a chart where it looks pretty erratic, but those large dips is where we have sold off a large portion of our RIF holdings. But every time we sold off our RIF, and it was a sizable amount, you notice that the income started to creep up again. And it would drop when we sold some more stocks, and then it would rise up again. But if you look overall, you notice that the high points, the income highs, is much higher on the far right than it was on the left. So that even though we're selling off, in fact, we expect to close out our RIF account by next year, our total income, investment income, continue to grow. And of course, that last dip is because we sold off a large portion of our RIFs in February. So again, you can just see it starting to rise again, and hopefully, it'll continue to rise to the point where we'll have more income than we did before. So that's the main difference, is the uncertainty of the market, whereas when you invest for income, you have a level of confidence. In fact, we have a margin of safety. It's not the same definition that other people use for margin of safety. It's the fact that our income, the amount of income we earn, allows us that if a company or two cuts the dividend, it won't affect our net income. We'll always still have more income than we need in retirement.
Yeah, certainly, Henry. I think just looking at that chart that we had showed, where you've gifted away over $1 million of your RIF there. I think a lot of people would sign up for that. Sounds pretty compelling here, Mark.
Yeah.
So, and growth through uncertainty there of the income. So let's hear your counterpunch here. What would you say to some of the things that Henry's brought up in support of income growth investing and in favor of total return?
Yeah, so I think, first of all, want to acknowledge the fact with Henry's approach that certainly drawing off some of your portfolio or selling some of your assets is an absolute way of gifting money or spending some of your money in retirement. Maybe a good visual to help, and I think I've shared this before on some other webinars with the team. Henry, I don't know if you see this, but Honest Math has done some really good work in terms of packaging some infographics and some visual aids together. And basically what it shows is, a couple kind of comparison stocks, if you will. So you may have stock A, let's say, that pays out lots of dividends or maybe high dividends, and so the yield is maybe 3 or 4%, and it kind of spins off some of those earnings and profits, what have you, to shareholders like you and me and many others. And your initial investment basically stays intact, right? And I think that's part of the thesis that you had talked about. And then you have stock B, if you will, where maybe you don't have as much dividend being paid out. But again, you've got a little bit more capital appreciation. So, there are some lower yielding but higher growth stocks in the TSX. And I happen to own some of those and I've truly benefited from those. And then you may have stock C in this example where, you're really focused more on a blend of capital appreciation and, you basically just keep your initial investment intact and the company paid out no dividends. So when I look at some of these examples, if you're taking a total return approach, whether some of Canadians, financial stocks or, utility stocks or stocks in other sectors, whether they pay a dividend or not, that's a board of director decision. You're actually incurring a forced sale. You're actually allowing the board of directors to make that investment decision for you. So in some ways, the dividend being paid for you is not unlike the company never paid a dividend in the first place, and you just sold some of the shares. So it's a perfectly valid strategy, dividend investing. I use part of that for myself, as I mentioned off the top. But I think what we're potentially having a different opinion on the argument is that if any company never paid a dividend at all, and you're taking a total return approach, you're banking on the company to make good use of their assets, grow products and services, acquire new companies, grow shareholder value in different ways. And so a company that never paid a dividend, you could just sell the shares directly.
Yeah, so Henry, what Mark's kind of talking about there is just that dividends are just kind of one other mechanism to essentially accomplish the same thing, I guess, in some respects, and that's just growth of capital. So what would you say to the points that he's brought up there, and as well as some other sort of counterpoints you may have?
Well, I don't object to someone investing for total return, but what I do say is that what does it take, or can you be successful investing just for income? And my answer is yes. When you invest for total return, you're always dependent upon the stock market continuing to go up or eventually going up. And you're always having to have a fairly high skill level. You know, Mark is considered probably one of the top financial bloggers in the country. The average investor, doesn't fall into that category. And, I just read an article in one of the papers recently, or actually today, that said that 60% of parents don't believe that their capital will last their lifetime, or it might last to their lifetime, but they won't have any funds left over to inherit, to gift to their kids or grandkids. And that's because of the market, and it's the market uncertainty. They're concerned about rising prices, they're concerned about inflation, they're concerned about tariffs. But all of those external factors really don't come into play for an income growth investors, because you're not dependent on the stock market for your income. You're dependent upon the companies. And if you identify quality companies that have paid and raised their dividend for a large number of years, that income they pay really doesn't come from the stock market. And certainly they could be affected by rising costs or tariffs, but I think you'll find that they're short-term concerns. They'll overcome those minor things, and very likely quality companies won't cut their dividends. It could happen, but probably your other holdings will make up the difference.
Okay, so those are some strong counterpunches there, Mark, that Henry's brought up here. Basically speaking of the uncertainty of future returns. I mean, we never know what the market's going to bring, and I think a lot of people might think things are looking kind of shaky right now. That might be the opinion of some. What would you say to some of the points that he brought up there, and give us your closing arguments in favor of total returns?
Yeah, I think I'll actually counter Henry's thesis a little bit in that, what would be simpler for most DIY investors, honestly, and other than to have like an all-in-one fund. You don't have to choose the companies of the day that you speculate may or may not grow earnings. You don't necessarily have to choose which sectors in certain countries, including Canada, may perform better than not. We don't have to choose whether financials will outpace energy, or energy will outpace telcos, or REITs will rebound, or what have you. So, I say this from a place of honesty, in that as a DIY investor who still owns a few individual stocks from Canada, quite a few actually, I'm looking at that as my own kind of dividend ETF, or my own total return ETF, to be honest. And so I'm very well aware that there's a big world. Arguably 97% of the investing world is outside of Canada. And so why wouldn't I want to take the returns from 97% of the investing world and just focus my portfolio on 3%? So to me, the uncertainty actually lies in a concentrated bet of individual stocks, not so much a pool of global stocks that you can invest in literally one ETF these days, which is low cost, it's simple, and what you really do is you focus on your savings rate. You can worry about tax efficiency. You can worry about eligible dividends or non-eligible dividends. And I've been on certainly this show before, and I'll happy to say it again. I think if people focused on global investing in a low-cost way that's disciplined, where you focus on your savings rate in probably RSPs or TFSAs, people are generally speaking going to be a lot wealthier and a lot happier, and they actually won't have to read the news clippings as much.
All right, Henry, it doesn't get much easier than one ETF, asset allocation ETF, right? I see Mark's point there. Give us your response to that. He's talking about the benefits of diversification, of course, which has been called the only free lunch in investing. So give us your response to that, as well as your final closing arguments here for income growth investing.
Yeah, no question. An all-in-one fund has a lot of pluses to it. But again, you're tied to the stock market. It'll only do as well as the fund or the index that it's following, whether it might include several indexes. But still, during a market crash or major correction, all stocks, dividend growth stocks, ETFs, funds, mutual funds, growth stocks, they'll all drop in value. So then you're in a situation, how low will it go? How long will it stay down? And, how long would it take to recover? And with income growth investing, you're not dependent upon, in fact, you look forward to down markets. I wish there would have been several market crashes since the financial crisis back in 2008, 2009. But still, our income has grown regardless what the market does. And the other point is that these all-in-one funds or any mutual fund carries a diversified portfolio. Some of them are quite small, some of them are thousands of stocks. And anytime you diversify and have a large number of holdings, you're going to dilute your potential income. And I run a monthly blog post where I do a comparison between a very high dividend growth ETF compared to a few individual stock selections or stock purchases. And, although I've only been running it for about 3.5 years, I'm averaging probably 30% more income than the ETF. And of course, an all-in-one ETF won't even provide that much income. They're probably down at 2%, whatever. The final point is that, in my view, any fee is too much of a fee. I don't care if it's 0.5% or 0.2% or whatever. Once your portfolio begins to get larger, those fees do add up, and they do become a significant amount of money. You probably end up paying $5,000, $10,000 a year. If that's all you held was one of those all-inclusive funds. So no, I prefer to pick my own stocks, and again, it's not that I pick them on an ongoing basis. I do the analysis up front. I come up with a list of quality stocks, and those are the ones that I stick with, unless the situation changes. But over the past 17, 18 years, there's only one stock that has really dropped off my list.
Pretty powerful results. I know you've had a lot of success with this approach here. So, Henry, thank you for the closing arguments there. And thank you to the both of you for sharing your perspectives here. We'll see what the audience thinks about them in just a few minutes here. Before we continue, though, just want to let our viewers know that if you're enjoying the show so far, we got a lot more of this where this came from. Every week we run this show. Make sure you can follow us, TD Direct Investing, on our social medias here. We're on YouTube, we're on Instagram, we're on Facebook. You can get a sneak peek at some of the upcoming episodes we have, plus a ton of other content designed to help you build your investing knowledge. Like these two gentlemen here are obviously quite sharp-witted here, so you can perhaps be the same here. Check us out here online there. That's it. Appreciate you guys giving us your arguments there. I'm going to have a couple questions of my own here before we hear from our viewers here. And Henry, one of the things I want to touch on you with, but actually before I do that, I should mention, viewers, if you haven't submitted your vote yet, make sure you do that right now, by the way. We're like minutes away here from the results, so make sure you make your voice heard. But Henry, I just want to pick on something here. One of the things that we didn't really touch on here is that if you want to live off your income in retirement the way that you do, you need a pretty darn big portfolio here. Most of these dividend stocks tend to pay something between like 3 and 5%, if not lower than that in some cases. So you need a lot of money to have a decent amount of income here. That could be a very legitimate criticism against the income growth approach here. What would you say to that?
Well, I think that's a large misconception. I had a chart up in one of my earlier conversations with you that showed the rising yield on investment. And this is something that most people don't understand, is that when you invest for income growth, when you reinvest your dividends, when you add to your dividend holdings, the yield that you receive from your investments increases over time. In other words, you might buy a stock today that yields a 3.5% or 4% yield. So you're earning that amount of income on that particular purchase. But over time, you'll find that your yield on your total investment, and I consider the funds that you add to buy new shares and the dividends that you reinvest as part of your total investment, that you'll find that your yield over time could become 6, 6.5, 7, 8%, and possibly higher, so that you don't need as much money, your own money, to build up a sizable portfolio to live off of.
Okay, so that's good points there. And Mark, I want to pick your brain a little bit here on something we didn't really talk about, which is that people are living longer than ever, generally speaking, here in this country. And there is some sequence of returns risk that they would have to deal with if they take a total return approach here. And I think some people could be nervous knowing that I don't know how long I'm going to live. I could live a long time. Am I going to outlive my nest egg, particularly if there's like a string of bad years there? Would something like income growth investing, where Henry's talking about his income is steadily rising over time here, would that not be a safer way, I guess, to approach building a retirement nest egg?
Yeah, I think it's a good point, Rob. I mean, I think safety is a bit relative. What I mean by that is that potentially making concentrated bets on some stocks that could work out well. But the flip side is true. So I kind of have a saying, and paraphrasing, of course, from some academics on this. But the same things that can make you wealthy are the same things that can make you poor. And what I mean by that is making concentrated bets on just some companies in some sectors opens you up actually to a lot of individual stock risk. The best or better way for most investors, generally speaking, is to think about, again, a global or a larger basket of stocks. And as you actually approach retirement, one of the things that people can consider is, dialing back some of their equity holdings, keeping some cash, keeping some money market funds, GICs, other kind of fixed income instruments. In that, to Henry's point, you can let your dividends flow in, or you can let the capital appreciation happen. But what you're doing is you're shielding yourself from that equity market risk. So by owning thousands potentially of stocks from around the world, not only are you participating in the growth story and or the dividend story, because again, some of these companies do pay dividends as well, what you're doing is you're allowing those equities to grow. Sequence of returns is that poor rate of returns just when you're on the cusp of retirement or just into early retirement. And so speaking about the asset allocation that I was coming back to, you can let 80 or 90% of your equities still run, but you can live off some of the cash reserves that you've got and shelter yourself from any market downturn potentially. I actually, I was speaking to Henry briefly just before the show, and I actually did a presentation at a share club here in Ottawa the other night, and they were astonished that you can take basically a pension-like ETF, a 60-40 equity and bond portfolio, and sell off percentages of that fund every year, this all-in-one fund, and you can actually be more than fine in retirement. So this is a vehicle by which you can just sell off some of your assets a little bit over time, and your returns will come back over time. And if you're really worried about your sequence of returns risk, you can keep some of those cash wedges, some of those cash buffers as you're entering retirement. So there's many ways we can go about reducing the sequence of returns risk. It doesn't have to be a concentrated stock story or not.
Okay, appreciate you filling that gap in us for. We're going to get to the results here now in just a moment here. But before we do, obviously a big thanks to both of you guys for sharing your positions here. I think you guys both made really strong arguments. I'm really curious to see what the audience thinks, but what I want to know is, what do you think the audience voted for, okay? Henry, I'm going to start with you. How do you think that the debate leaned? What do you think the voters are going to do? What's the split?
Well, I believe that probably 75 to 90% of investors follow Mark's strategy. I think they believe that capital appreciation certainly is probably the best way to go. But, one never knows. But I will just add one point, is that, you talk about 4% withdrawal rate. Well, how big of a portfolio do you need to take a 4% withdrawal rate over 25, 30 years? Probably $1.5 million to $2 million. And by the end of that period, maybe you don't go broke, but most of your capital has disappeared. When you invest for income growth, you're living off the dividends. So no, unfortunately, I'll have to stick with, be the minority and stick with income growth investing.
Okay, well, Mark, I don't know, maybe Henry's trying to play a little bit of an underdog role here. I don't know, but what do you think? How do you think the vote split here, Mark?
Yeah, he's probably trying to get in my kitchen a little bit here. I actually think I made some compelling arguments. I think, generally speaking, for most DIY investors, they're better served in not a lot of stock picking. They can do it if they choose. I've done it in the past. I still own individual stocks. I just happen to own many more, probably, twice as much in Canada that Henry owns, to be honest. And that's okay. That's a personal choice. That's a personal preference. But I can't ignore the returns of some of the U.S. stock market over the last 10 to 15 years. I can't ignore the fact that all the trends are pointing to potentially emerging markets, coming back into favor and roaring back for returns. And so when I think about the growth potential that's available to me, I just don't want to ignore it. I just don't want to make concentrated bets on just a few stocks, albeit it can be very successful. The other thing I would like to add is that, and it's a bit of a bias, but the hybrid investing strategy also works. You can own individual stocks, a collection of them, and you can own low-cost ETFs. And I think I'd like to say I'm a bit of a living proof the strategy can work for semi-retirement or early retirees who aspire to do so. But I'll come back to maybe 4 generic points that maybe Henry and I didn't pick up on. And regardless of the strategy you choose, I would ask people to really think about what are their clear goals, what are their investing objectives. Henry is an income-focused individual. I'm more of a total return guy. That's point number 1. 2, I'd like to leave DIY investors to think about their balance. So what is that mix of stocks and bonds that allow them to sleep at night factor? For Henry, it's okay to have the income stocks delivering the dividends, and that's great. But other people may not be as ready or willing to let certain stocks run or ride, regardless of the prices, the highs or lows. The third point I'd like to bring up, and we talked about a little bit, is keeping your investing costs low, avoiding trading, speculating with your portfolio. Henry would agree that diving in and out of stocks, whether they pay dividends or not, is probably not a great strategy, just because you're changing, you're incurring transaction fees and you're manipulating, undermining your own behavior. Which brings me to my 4th point, which is investing discipline. Focus on a good savings rate, focus on registered accounts, and try to just stay the course. I also celebrate when stock markets fall. I buy some low-cost ETFs and individual stocks at times too. So it's not a individual company or not story. There are different ways to invest, and certainly a hybrid approach has worked for me.
Yeah, certainly. I think regardless of how the vote shakes out here, which we'll get to in just a moment here, I think you guys are both living proof that either strategy can work. It really depends on your temperament as an investor, but staying disciplined with your strategy can pay huge dividends, no pun intended, if you're committed to it, right? So great stuff, guys. Anyway, without further ado, let's reveal the results here. What did our audience think? Okay, so we got total return Mark, 42.5% income growth for Henry, 57.5 Henry. Congratulations, you are the winner. Look at that, maybe a little bit of rope-a-dope there, He comes in as the underdog, and then there you go, he wins. How do you feel? Are you surprised?
I am surprised. I really think that probably the large fan base that Mark had must have stayed away.
I don't know, Mark, what, you think your people let you down, or what's going on here? How do you feel?
Yeah, I think some of them just have already bought and drank the Kool-Aid of what I talk about. So there's no need to vote. There's no need to really weigh in too much and ruin Henry's parade. But I think it was a close argument. I think there's merits on both sides of the equation, and certainly I do appreciate where Henry's coming from in terms of the dividend story, but I would close by saying it's not always the be-all, end-all. These companies do need growth to actually pay the dividends.
Well, gracious in defeat, good-spirited defeat, good-spirited argument. Thank you guys, both of you again. And thank you everybody, of course, for voting. But we're not done yet, okay? That's the debate portion of our conversation, but we're going to open the floor. We're going to take some questions from our viewers and find out what they want to know more about. So are you guys ready to get at it here?
Fire away.
Yeah, let's go.
All right, I'm looking up my first question here, and this is from Angie. Angie is saying, I'm worried that when drawing down a RIF, investments get sold, which reduces dividend income going forward. How do you recoup those dividend income losses? This is a question for both of you, but maybe, Henry, let's start with you.
Well, there's this great debate about how much one should withdraw from their RIF. And my preference is to draw it down as quickly as possible while minimizing the taxes. And even if like we withdrew from our RIF, but we gifted most of the money to our kids and grandkids, and we also put money into our tax-free savings account. And even if you just draw down and put it into your non-registered account, I think you're better off than just letting the money sit in a RIF account. Certainly it'll grow and compound tax-free until you withdraw. So the higher the balance in the RIF account, the greater your taxes will be at a later date. So I think you have to look at your total income sources and hit a happy medium. How much can the maximum amount you can afford to withdraw from your RIF, and either reinvest it in your tax-free savings, your non-registered, or just gift the money to your kids and grandkids. Or donate it. I guess you don't have to gift it.
Right. Mark, why don't you opine on this one for us as well?
Yeah, I think where Angie's coming from is maybe just the concern that if you're selling part of your RIF, or you're forced, obviously it's a forced withdrawal mechanism, that whether or not you invest in dividend paying companies or not, the capital is coming down, and that's very much true. This is where, again, the growth story comes in, because if you read various academic articles, I think as you age, you actually want a higher equity glide path, if you will, right? You want a higher biased equities because you want that compounding time, as Henry alludes to keep growing. And so, keeping a portion of your RIF withdrawals in cash equivalents for when you need the money, but then allowing the rest of the portfolio to either pay dividends, interest, or have capital appreciation is actually a winning strategy, because you allow yourself a little bit more longevity, if you will, to withdraw from the portfolio. And Henry's correct. When you take the money out of the RIF, it doesn't mean it must be spent. It can be moved to your TFSA every year. Every time a new TFSA contribution room opens up, you can put it in your non-registered account. You can obviously donate and what have you. But I do appreciate the fact that RIFs are forced withdrawals. And so the point I would leave you with is making sure you look at RIF withdrawals as just one piece of an overall income story, whether that's from CPP, OAS, pensions, or other assets.
Right, good point there. Let's keep this train rolling here. Patrick's got a question for us here. Patrick wants to know, Henry and Mark, do you find that many investors experience the dividend gross up in Canada increasing their income to the point where retirees lose most of their OAS, old age security? And if so, is that not a reason to use capital gains on stocks as income instead? Mark, why don't we start with you on this one?
Yeah, this is a great question, Patrick, and thank you for that. I think I invest in some individual stocks in my non-registered account, but there would come a point where when I add up potentially longer term, all income sources, to your point, CPP, OAS, RIF withdrawals, what have you, I may be into OAS clawback territory, and that's not really great. So depending on what assets you own and where you own those assets, i.e. in a non-registered account, you could make a much stronger case that you should probably focus on capital gains, and really ignore the fact or limit the fact that you have a heavy bias to dividend paying companies, especially in a taxable account. I would encourage, like Angie, to look at your total income needs and wants in retirement or semi-retirement. Look at all the income sources that you have and look at the timing of those income sources and when they come online. So for example, maybe you make strategic RSP withdrawals or RIF withdrawals sooner than age 71 when you're forced to convert to an annuity or to a RIF. Potentially, you sell off assets in a non-registered account for capital gains because it's a very efficient form of taxation. So looking at all your assets as a total portfolio, as a total return portfolio, is probably very tax efficient, but it's also very good for your spending needs as well. But it's a great question, and I echo your concern.
Okay, let's keep this train rolling here again. Stefan has a question, and Stefan wants to know, this is for Henry. Henry, do you think the study of safe withdrawal rates provides a way to plan for the uncertainty that you were talking about in the stock markets?
Well, when you invest for income, and especially if your time frame is 15, 20, 25 years, every year you're going to see your income growing, so that by the time you are ready to retire, you'll know exactly how much income you're going to receive from your investment portfolio. And as far as the safe withdrawal rate, well, hopefully you'll reach that goal of earning more income than your retirement expenses, which means your withdrawal rate is zero. You never have to worry about selling capital. unless you want to. So, you know, if you're dependent on capital gains, then you're always concerned about a withdrawal rate because you don't want your capital to outlive your life. And that's where you get into variable withdrawal rates, or you start adjusting your expenses each year depending upon what the market is doing or what your stock values are doing.
Mark, I'd love to get your take on that question too, because as a total return investor, safe withdrawal rates is something really top of mind for you, I imagine. How do you think about safe withdrawal rates? Is there a number in your mind that you think is a true safe withdrawal rate, perhaps?
Yeah, it's a good question. I mean, I think where the question is coming from is looking at Trinity studies and things around the 4% rule. So again, just to elaborate for the viewers, if we're thinking about, let's say, a fairly healthy $1 million portfolio, you could conceivably sell off 4% of that portfolio every year, adjusted for inflation, and potentially never run out of money for at least 30 years, based on a 50-50 kind of stock and bond mix. So that's a bit of the primer there on that. I actually think, when we think about safe withdrawal rates, I think people have to remember that these are rules of thumb. They're interesting studies. We don't live life in a spreadsheet or in an academic paper. So these are good starting points. But ultimately, when we think about 4% yield from a stock, say that company never paid a dividend, right? You would be probably selling 4% to actually take your income from. So, in all practical terms, Henry and certain income investors, and again, I include myself as a bit of a dividend investor as well, the board of directors is actually making the decision to give you that 4% yield or that 5% yield. That is your withdrawal rate. It's also your floor for where you're spending. The counterpart, I'll also argue to this one as well, is that if you're only just living off the dividends and you're not focused on the growth side, you actually may be underspending, right? So when we look at 4% withdrawal rates, they are just that. They are the bare minimum. And studies have actually shown that if you don't increase your spending rate over time, say you're getting 6% overall total return or 7%, if you're only spending 4, withdrawing 4, 3% is going to keep compounding. That's great. But if you don't want to leave a legacy and you don't want to leave a big generational wealth, like some people I know don't, they want to actually enjoy the money while they've worked for it, enjoy the time with their kids and families and what have you with the money they've built, then you actually have to increase above the safe withdrawal rate over time. So it's a nuanced answer, but I would say, generally speaking, rules of thumb are great starting points. But we all don't live in a spreadsheet, and life and spending is dynamic. And I think people need to think about more of a variable withdrawal strategy than just living off a certain yield or certain income level, to be honest.
Yeah, you're right. It is very situation dependent. I know for me personally, the safe withdrawal rate that I subscribe to is the one that allows me to buy a Ferrari in my golden years. But in any case, that's all the time we have for the questions here. Thank you, everybody, for submitting them. And thank you both for doing your best to answer them. Fantastic answers, fantastic perspective, as always. But we're going to have to leave it there. Thanks again for joining us, everyone. And make sure you check out next week's episode. Okay, we're going to keep the retirement theme going here. Thursday at 2 p.m. Eastern next week. We're tackling the contentious retirement topic of when to take CPP and OAS. Could you be making a big mistake taking them too early or too late? Find out next week. For now, though, that's all the time we have. From everyone at Inside Investing, thanks again for watching, and we'll see you all next time.
Vous avez d'autres questions? Cliquez sur les liens à droite et dans la description ci-dessous.